Hi guys, Joseph Carbonaro here from GetGround. I do hope you're all keeping well. So I've been asked to speak to you today on behalf of ERE Property, our partners, to answer some of the questions that you might have around limited company structures. So just to introduce myself before we get started with those questions, at GetGround, we are specialists in setting up, structuring and doing the ongoing management and accounting of limited company structures to hold the buy-to-let purchases that you make with ERE Property. Our website, if you'd like to check us out, is www.getground.co.uk. And again, please feel free to reach out to me personally. My details are on the website if you want to discuss anything to do with limited company structures around your property purchase. So what are the tax benefits of buying in a limited company structure? I think this is a great question, and I suppose the best way to break it down is at the three different stages of your property investment life cycle. So the first one is when you're buying it. The second is when you're running that property or renting the property out. And the third is when you sell that property or you exit your investment. So dealing with the first part, when we buy the property, obviously everybody knows about stamp duty or SDLT. Really, there's no difference with a limited company from a stamp duty perspective. The property purchase price and you as a person and your situation tend to determine the stamp duty liability that you'll pay. And as always, stamp duty that you pay in your personal name will be exactly the same, therefore, to a limited company structure. When talking about tax, it's always great to seek tax advice and also seek independent legal advice as well. The second part of I suppose an investment property life cycle is when we're renting the property out, which is why most people are buying investment properties to rent them out. So the first thing really is the difference between income tax and corporation tax. So income tax in the UK, most people get a tax-free allowance, which is anything up to £12,500. On top of that, it's 20% up to just under £50,000 now. On over £50,000 or just under £50,000 is the threshold, is a 40% bracket. And then that goes right the way up to you reach £150,000 where it goes up to 45%. Conversely, corporation tax in the UK, any company that turns over less than £50,000 per annum, of which it will if you use a GetGround limited company structure, would be taxed at the small business rate of 19%, which is corporation tax rate. Furthermore, anything that represents an expense to you of running that property, so ground rent, service charge, property management fees, and the all-important one at the moment, interest on your mortgage, so interest on the loan, is tax deductible, which means that you can pay those expenses before paying corporation tax. If you have £100 of rent coming in every month and your ground rent, service charge, management fees, etc. equal £40, then you'll only pay corporation tax on the £60 that remains. Some of those benefits are also present in your personal name, but mortgage interest, which is probably the biggest cost that you'll experience as a landlord if you're mortgaging the property, isn't tax deductible. The next thing is how do we actually take income from the company structure when it's set up? So I'd say that what most people are aware of is something called a dividend. Dividends depend and whether they're right for you, you will need to speak to a trained taxation advisor. But with a dividend, anybody in the UK gets their first £2,000 from all of the companies that they own cumulatively to take as a dividend. After that, you have the small business rate, the small dividend rate, which is 7.5%. And then on top of that is 32.5% if you are a corresponding higher rate taxpayer. So what a lot of people do is they create a mechanism called an owner's loan. And an owner's loan in its concept is where we loan the company some money, more often than not for the deposit on the property itself. And then when that property is generating rent, it can choose to repay the owner that loan. One of the benefits of taking an owner's loan repayment is that after corporation tax has been accounted for, there's no further taxation liability and the income doesn't need to be declared to Her Majesty's Revenue and Customs. What that means is a lot of people, and particularly for higher rate taxpayers, have a choice of buying their rental property, getting a little bit of deductibility on their expenses, and then paying 20% or 40% in income tax, which is particularly heavy if you're a high rate taxpayer. Or you buy in a limited company structure, get full deductibility on all of your expenses, including mortgage interest, and then pay 19% in corporation tax on the balance. As with everything here though, guys, please do seek independent tax advice and seek independent legal advice if necessary. Finally, one of the last mechanisms here is a director's pension contribution. So here at GetGround, we can move £10,000 per company, per property, per director, and move it to a pension pot here in the United Kingdom of your choice. The good thing about that is because we do that as an expense to your company, there is no tax payable on that pension contribution, which is a great methodology. And of course, you can mix and match those mechanisms. So you could take your first £2,000 as a dividend, your next £4,000 as an owner's loan repayment, and then make a £2,000 pension contribution if you wanted to do that. As always, this is not tax advice, and we do recommend that you seek independent tax advice and independent legal advice if you need it. Final thing, I suppose, or the third stage of the tax benefits of a limited company is actually when you sell. So you have two options. If you have a limited company set up, structured, and run with the right legal documents in place, you actually have the ability to sell your limited company structure. So rather than selling the property out of the limited company and then maybe shutting the company down, you actually have the ability to sell the limited company structure as well. There are two big benefits to doing this. The first is that you pay a lower level of capital gains tax. So normally for a low rate taxpayer, it would be 18% on your capital gain. And for a high rate taxpayer, it would be 28%. If you sell the shares in the corporate structure, at the low rate is just 10% and at the high rate 20%. So it's a net 8% benefit for selling the shares rather than selling the property. The additional big benefit to that is that when someone buys the company from you, they won't pay stamp duty on the purchase because obviously they're buying the shares in the company and not the property itself. There is a tax on the purchase price of shares, which is 0.5%. But as I'm sure a lot of you will agree, that's a hell of a lot lower than the typical 3 to 5% that people experience when paying stamp duty normally. So that really sums it up, I would say, in terms of the tax benefits to a limited company structure. It tends to be much more efficient when actually running the property, and it can also be big benefits for us when planning for things like pension or retirement planning. As well as when we sell the corporate structure, there's big benefits there from a kind of exit perspective as well. As with everything here, this isn't tax advice, and we would advise you to consult your independent tax advisor as well as seek legal advice if you need it. Cool. So second question, are there any non-tax benefits to limited company structures? Again, this isn't advisory, and I would always encourage you to seek independent taxation and independent legal advice wherever possible. So with limited company structures, there are, of course, non-tax benefits to doing that as well. Really, I think they come in the form of limited personal liability, increased flexibility, which allows for increased inheritance tax planning, and also access to a pretty varied mortgage market here in the UK as well. So to explain those things in a little bit more detail, limited personal liability, what does that actually mean? Well, liability just means risk, effectively. Now, whenever we go out and we buy investment properties, there are risks that we need to be aware of. First of all, financial risks. Okay, so to give you a bit of a tenuous example, but an example nonetheless, you've got a mortgage on a property, tenant stops paying the rent, the default on the loan, and the property's repossessed. Pretty tenuous, but that could be a financial risk. The second type of risk is a physical risk. So an example of a physical risk could be you go out, you buy a brand new house and the boiler breaks or a wall falls down. You find that there's something structural that's wrong with the property. Now, whenever we've got a property investment that we're considering or that we have bought, it's very, very, very important to look, at least where possible, to isolate the risks associated with buying that particular buy-to-let property, financial and physical, from A, your personal property, your own house, your own car, B, the other buy-to-let properties in your property portfolio, and C, your trading business if you run or operate one. So we here at GetGround advocate a structure of one property per limited company. And one of the main reasons, alongside some of the tax benefits and things that can bring to people, is to help you to mitigate against the associated risk, financial and physical, from buying that buy-to-let, from all other parts of your life. So widely considered to be a more safe way of operating buy-to-let property. The next benefit is to do with flexibility. So, for example, limited company structures can give you a lot more flexibility with what you can actually do when you own a property in terms of changing or altering the ownership structure of it. As you know, when you buy a property in your personal name, it's phenomenally difficult, legally speaking, to make changes to how you actually own that property. There are methods of doing it, gifting, a certain amount of property away, but the point is phenomenally legally restrictive, very, very difficult to do. Really, there are only two ways of actually managing your property or making changes to the way in which you hold property in the UK, and that's a sale. So selling the property or dying and passing that property down to a beneficiary in the form of an inheritance. Neither of those two things, if you think about it, are particularly good methods or particularly good options for managing your personal property. So if we have a situation where we have a limited company structure and you have one property per limited company, for example, you actually have the ability to make gifts at any time without restriction, obviously subject to mortgage lender's approval and certain other things. Make a gift at any time without restriction to someone who is over the age of 18. Therefore, if you wanted to transfer 50% of the ownership in your property through transferring 50% of the shares in your company structure to a friend, family member, beneficiary, you would have the option to be able to do just that. Now, naturally, that helps with inheritance planning, which I think is a question that I'll be covering off very, very shortly. But being able to make changes to how we actually run and operate the properties is widely seen as a massive non-tax benefit. I'd say the final thing really is access to what is an ever-changing and rapidly growing mortgage market here in the UK. So traditionally speaking, mortgages here in the UK for limited company structures are a little bit higher in terms of the rates that you typically get when buying buy-to-let in your personal name. That's not necessarily a bad thing, and please do remember from the previous question that you can deduct all of your mortgage interest from your tax bill should you have a interest on the loan and be running a corporate structure. Now, last year in the UK, there were about 85,000 buy-to-let properties bought in the UK. So this is 2020's figures. 41,700 of those were bought through a limited company structure, which makes it the fastest growing sector of the mortgage market in the UK, bar nothing. As a result of that, what we're seeing is new lenders coming into the market, new products being offered all the time, particularly in the context of seeing the end of coronavirus. We're seeing rates come down, we're seeing LTVs come down, minimum investment values and things come down. As a result of that, we're seeing what is currently a very, very exciting mortgage market, and one where rates are becoming much more competitive. Again, I think that's a potential benefit. Particularly as, if you can work the maths, it could be immensely profitable for you to use a limited company structure. So those things really, I would say, are the main non-tax benefits of a limited company. Limited personal liability, generally considered to be a little bit of a safer way of purchasing property than holding it in your personal name. The second is the ability to make changes to the ownership structure of a company, being much more easier than to do that for a property in your personal name. And third is a really, really exciting and rapidly evolving mortgage market that we have here in the UK. As always, please do consult your tax advisor and seek legal advice where necessary. None of the above constitutes advice. Cool. So question number 3, inheritance planning. Can limited company structures help with inheritance planning? And the answer to that question is yes. As always, guys, please do seek independent tax advisory. Please do seek advisory around your inheritance planning. Please do seek legal advice where necessary. And none of what I'm about to say constitutes legal advice. So in terms of inheritance planning, because we can make changes to the way in which we run a company structure, that does lead us to be able to make really cool decisions about how we think about inheritance planning. And a cool way to do this might be to give you an example. So we had a gentleman not so long ago who wanted to buy a buy-to-let property for his 2 grandchildren to leave as a bit of a nest egg. But he had a bit of a conundrum in the sense that he actually wanted to use that rental from that property to supplement income in retirement, which I suppose after working as long as you have, you're perfectly entitled to do. So he set up a limited company structure with GETGROUND, 100 shares. He gave himself 1 share and a directorship. He gave his wife 1 share and a directorship. He gave his 2 grandchildren 49 shares and 49 shares respectively. They then made an amendment to one of the legal documents which we provide here at GETGROUND, which essentially meant that the 2 children didn't have any practical control over the way in which the company structure was run. And what that meant was largely the company had separated the economics or the day-to-day running from the control. That was great because what that meant was, whilst Grandad was still alive, he could take an owner's loan repayment direct to source, which meant that he could effectively take the rent from that property after tax was taken care of. But when he is to pass away and it's time for the government to look at the estates and inheritance liability, he only owns 1 share in the limited company structure. So the children's inheritance liability, if anything, if it falls below the threshold of 325 single, 650 for married, would be 0. And if not, it would be 40% of his 1 share rather than 40% of the property price. So limited companies help us to mitigate against a lot of the associated costs and a lot of the associated difficulties of inheritance planning. Again, none of this constitutes tax advice, and please do seek your own tax advisory and your own legal advisory where appropriate. So, question 4, is a limited company expensive to run? It doesn't have to be, is the right answer to this question. So, here at GETGROUND, we typically charge £99 plus VAT if you're a UK resident to set up and structure the company, as well as provide a UK bank account and a company secretarial service. That cost is £299 plus VAT per company if you're based overseas because of the additional checks and things that we need to do. And then the ongoing running of the limited company structure, which includes provision of the bank account, provision of the online platform, the accounting, tax filing, any amendments to any legal documents that you might require, company secretarial services, and access to anything additional, mortgages, for example, is £20 a month plus VAT. So effectively, someone could run an entire limited company structure for £240 a year plus VAT, which is very cost effective. So the answer is it costly to run a limited company structure? No, and if you do want to explore that, we do definitely say get in touch with us here at GETGROUND, and we'd be happy to help. Cool. So question 5, how easy is it to set up? The answer to that question is probably quite easy, dependent on how familiar you are with these things. But again, here at GetGround, we do make these things very, very easy for you. So all of our companies can be designed in as little as 20 minutes, and then we will go away and actually incorporate the company for you, which should be set up within 24 hours. In order to do that, you need a couple of things: your passport or a copy of, a proof of address, bank statement, utility bill, the address of the property that you're purchasing, and of course you can get that from the guys at ERE, the solicitor's details, if you have them, your breakdown of a shareholder split, so who owns what slice of the pie, so to speak, if you need any help with mortgages, things like that, and then obviously a payment for the company setup, which can be done via a credit or a debit card. Really, really easy to do. It takes most of our clients less than 15-20 minutes to do in total, and then about 10 minutes for every second or third company that needs to be done, and we can have the whole company set up, structured, and with the bank account in place, more often than not within 72 hours. So is it easy to do? Yes. Is it fast to do? Yes, in the context of using our services here at GetGround. Cool. So great question. Number 6, are there any restrictions to creating a limited company structure? Not really is the answer. So anyone of any background, any nationality can create and be a shareholder of, in the context of their own legal system, of course, a shareholder in a company here in the United Kingdom. So we don't have any rights here as UK nationals that anyone else doesn't have. You're free to create, structure your own limited company here in the UK. Here at GetGround, we do various background checks. So we will do checks on the money that you're using as a deposit. That's called anti-money laundering checks, just to make sure that you're not buying properties in the form of proceeds from ill-gotten gains. We will, of course, make sure that we conduct background checks on you and your fitness, you're fit and proper to be a director in a limited company structure. And there are some geographical restrictions in the world there are some geographical places in the world which have their own restrictions about becoming a limited company director, and you must obey and follow the laws of the land. But overall, no restrictions on anyone of any nationality setting up a limited company structure with us. Cool. So, final question. Are there any misconceptions about setting up or operating a limited company structure that you need to be aware of? Obviously, again, one final time, this is not tax advice, and please do consult your own tax advisory and your own legal advisory where appropriate. Some of the questions that we get, or some things that we get asked, are is stamp duty costs higher for limited company structures? Again, the answer to that question is no. So whatever you would be paying in your personal name to buy an investment property, you would also pay in a limited company structure as well. So £5,000 if you were to buy that property in your personal name, it would also be £5,000 in a limited company structure as well. Again, please do consult your tax advisor or your lawyer on your stamp duty liability. Second, I suppose we've kind of already covered this off, but is it a time-consuming and expensive process to establish a UK limited company? And I suppose traditionally it can be. Here at GetGround, we've made that process very, very easy to do. I think really our kind of one of the things that makes GetGround such a great platform for investors to use is just how easy it is to set up, structure, and operate a limited company. And of course, all that can be done for setup can be done for £99 plus VAT for UK nationals, and £299 plus VAT for overseas nationals. And then you can run your company structure for £20 a month plus VAT, which is incredibly affordable. So is it a time-consuming and expensive process? No, in the context of using GetGround. I suppose the third one, obtaining financing. People think, is obtaining financing challenging? how much more difficult is it to obtain financing using a limited company structure than buying property in personal name? I suppose the good thing here at GetGround as well is because we've created so many limited company structures for our clients now, we've developed a really excellent network of partners and brokers. We've got strong relationships with many independent and respected mortgage brokers. And as I said before, there are a situation where nearly half of all buy-to-lets purchased now here in the UK are bought through a limited company structure. So rates, mortgage products that are available are coming down in value. We're still seeing rates slightly higher than one would have typically in their personal name, not by much. And of course, the benefit of a limited company structure is you can deduct that interest on the loan as well. The interest is tax deductible. So generally, I would say that is obtaining financing challenging for UK limited company structures? No, it's certainly something that the guys at ERE, I'm sure they can help you with. And again, we can also do that and regularly do so for our clients as well. I suppose the final thing we get asked really is it harder to sell a property contained within a limited company structure? No, is the answer to that question. There's absolutely no difference as a buyer for you between buying a property that's contained in someone's private name or buying a company or buying a property from a corporate structure. The additional benefit to holding a property in a corporate structure, of course, is the fact that you can actually sell that corporate structure as well. And there are some tax benefits and some non-tax benefits actually to that as well. Which I'd be happy to kind of go through with you in more detail. So generally, is it harder to sell a property that's contained within a limited company structure? No, I would actually argue it's the opposite. I think you've got more options for sale. Again, none of the above has been tax advice, and we would recommend that you consult your own lawyer and your own tax advisor where possible. Please do reach out to me. My email address is joe.carbonaro@getground.co.uk, and our website is www.getground.co.uk. If we can help you at all, or you're interested in learning a little bit more about limited company structures for your property purchases with ERE Property, please do reach out. We'd be happy to help.